Tech stocks have been rattled recently, but their performance throughout 2017 and most of 2018 has been gravity-defying, to say the least. Up until recently, it seemed as though they were unstoppable. The market realized the weakness, and two of the FANG Plus stocks took a turn for the worse. Will investors buy the dip, or is this a dead cat bounce? You came here for the truth, so let me unveil that for you. Today we are going to look first at tech stocks. I want to talk about China. I want to talk about the GDP and various issues. After that, stay tuned for a jam-packed episode. Let's begin by taking a look at these two charts. I want to have my focus particularly on the left-hand one, global tech earnings per share versus everything else. And what's interesting and should not be surprising to anybody is that when you look at the world excluding tech and e-commerce, you see that, yes, the trend since the financial crisis has been upward. But compare that to tech and e-commerce and you see a completely different picture. These numbers have become astronomical over these years, particularly throughout 2017 and on. It is going higher and higher, and it, as I said in the beginning, is gravity defying. On the right-hand side, US earnings per share versus everything else. You'll see the global, excluding the US, is essentially non-existent, but the US, of course, is hitting new highs all the time in every category, all because it is focused around a few stocks. These are the tech and e-commerce stocks. Okay, we have the FANG Plus stocks, two of which just recently took a major nosedive, each of them about 20% on the way down. That is quite significant to see that these numbers are in fact record-breaking in the case of Facebook in the amount that they've dropped. In one single session, losing a lot of money. Zuckerberg lost something like $15 billion instantly, just evaporating. Sure, these stocks may come up. His net worth may come back up. I'm not suggesting that it isn't going to happen. I don't know what's going to happen, but I do know that without quantitative easing, this market cannot continue. That's what it needs right now, because it's no different than an alcoholic who wakes up with a hangover and they take another drink, and that will somehow resolve their problem. A map of hubris and humiliation. So we are comparing these companies to different countries. And I've said this for a long time, that corporations are a lot bigger. They're a lot more powerful than countries. They've gotten to that point, not just in the amount that they're worth, but they control these countries. They have their people in positions of power. They have all the tax breaks. If you think about it, Amazon, here we are. You have this big corporation. They employ a lot of people. Of course, like any others, they're trying to eliminate the amount of people they have, trying to increase their profits. But you have a company like this who decides, we're going to open up a second headquarters. And then all of these different cities say, we'll give you $1 billion in tax rebates. We'll give you $2 billion in tax rebates. We'll help you with anything you need. We'll give you whatever it is. We'll help you. Just build it here. And cities are fighting over who should get that next headquarters. So this right here tells us that we have companies that are, they have more control. They have more decision-making power. They have the money. They have the liquidity. So, in these examples here, you're looking at Facebook being bigger than the country of India. Microsoft and Apple together are bigger than China. Netflix is bigger than Russia. Alphabet here, what's showing us Southern Europe. Alphabet's bigger than Southern Europe. I mean, there's many examples. So that's what I wanted to show you. Now, I wanted to connect that in with what's going on in China today. You may not know about this. I'm not going to read the whole article, though I absolutely recommend that you read this. It's out of the Wall Street Journal. This is a very important article to see what's happening, not just within China, but with technology. All right. It handled more payments last year than MasterCard, controls the world's largest money market fund, and has made loans to tens of millions of people. Its online payments platform completed more than $8 trillion of transactions last year, the equivalent of more than twice Germany's GDP. Ant Financial Services Group, founded by Jack Ma, you may know him from Alibaba, has become the world's biggest financial technology firm, driving innovations that let people use their phones for buying insurance as easily as groceries, enabling millions to go weeks at a time without using physical cash. Now, this is huge. What we're talking about is the Alipay system. You may have heard of it before. Apple Pay, Android has its own system. There's PayPal, all of these different digital means of transacting. And in China, this is massive. This is huge. It's, something that more and more people are adopting. In fact, it's so big, it became so important to people in China right now that the government had to step in and actually put curbs on what they can do. They said, no, you can't do this, no, you can't do that, and actually restrict their ability and their level of expansion. You can see this in this article here. I'm not going to read all of it to you because it's just really long. That success is also putting a target on the company's back. China, even more than the US, is now under pressure to reckon with the disruptive power of a financial technology giant. It talks about the regulations that are being put in place to stop it from growing so fast. The People's Bank of China has even stuck their nose into it. The government itself, of course, has been really trying to squeeze them here. Now, I don't think that they're necessarily doing anything that they were not allowed to do, but they can see where the growth is going, and they want to make sure that the banks, the traditional way of lending, is still being used, because that goes through the central bank, that goes through the commercial banks, the way that they loan. They can keep control of it. If they start going into this type of method, then we put that control into the hands of these businesses, which they don't really want to do that necessarily. Maybe in a longer term scenario, but it happens too fast. The banking industry is too slow. They're outdated. They have a lot of red tape. A company like this is all about growth. That's all they're worried about here. So there's more to that, but I'd like you to check it out for yourself. I'm just going to show you one more thing here. See this? This is a chart basically trying to compare this company to others. Money fund Colossus assets under management at Ant's largest money market fund now rival the volume of individual savings deposits in China's largest banks. That's how massive. It's huge. We're talking about levels where they're becoming a competitor to the biggest of the bigs. Of course, it'll be too big to fail when that comes around. Now, I just wanted to show you this here. Looking back at all of the previous bubbles that we've seen, whether it is the housing bubble, tech boom and bust, and today we have again this e-commerce bubble, tech FANG stocks, whatever you want to call it. So previously, what we had seen was that the Fed funds started off at 5.26% brought it down to 0%. Okay, obviously that's a drop, 5.26. That isn't much. So now they've brought that up to a level that is quite weak, I would say. But, we're hovering around this 2% mark. It's going to be there soon. It's going to exceed that soon, I should say. And then off to this, what I believe is very significant, 3% mark. That's really, I think, there will be an event. I don't see how it can get any further. Many people will say that they just won't go any further, but that remains to be seen. This compares all the previous recessions and how significant the drop that they do in interest rates are. And now today we have barely any room in order for them to pull interest rates up. They'll have to go into the negative. There is no other option. They'll have to engage in quantitative easing far beyond what they did before. And here they suggest $3.6 trillion worth. Now, you saw the GDP numbers, which are stupidly fake, and I'm really tired of it. But hey, this is what they provide us with. Now, there were some revisions which made it seem better than it was. With the Friday data, the Commerce Department also released comprehensive GDP revisions going back decades. They showed a higher household savings rate than previously reported, as well as faster growth in the first quarter of recent years, though the overall narrative of the economy's performance over the last decade wasn't much different. Now, what we're seeing here is because of revisions that happened to boost the entire situation, making it look better than it actually is. Look at this, $1 trillion in revisions. So significant, and they just make it seem like, we just revised something, don't worry about it, don't look at it, and that's the way it is. The economy's doing well, and so on. You can make all these excuses for revisions, but I'm not buying it. All right. Now, I've shown you the videos before about what Russia is doing, and they have been liquidating their assets, as they say here in this article. I found it interesting that they were basically saying everything I was, yet there have been many people suggesting this isn't significant. It's not enough money. And I never challenged the fact that the total amount that they've sold off is the problem. It's that we're going away from the US treasuries. That's Russia. China has been stating they want to do this. Japan has been selling off for the last few years. They've been unloading. And it really shows us that things are changing. That's why I brought it up. Things are changing. All right, now taxes, very quickly, just going to cover this in one more article. Nearly a third of property tax revenue in Chicago is diverted into 143 TIF districts, that is tax increment financing, controlled by the mayor, nearly half of which are located in affluent neighborhoods. Your tax dollars do not get used properly. They are always, I'll be nice and say misallocated, but you can call it what you want. This is just one more example of that. Human bankers are losing to robots as Nordea sets a new standard. Something interesting happened in Swedish finance last year. The only big bank that managed to cut costs also happens to be behind one of the industry's boldest plans to replace humans with automation. How does that sound? Well, this is something that I've been talking about for quite a while, continuing this to document it over the weeks, constantly bringing out new information, showing you how robotics and this automation, whether it's AI, whether it is, different types of systems that they've set up in order to replace jobs. That's the purpose of this. They're trying to increase efficiency, productivity, and ultimately what that means is Eliminate humans because they work 8 hours a day when robots work 24 hours a day. They do not take breaks. They do not ask for anything else. They simply work round the clock, and we have to be ready for what's coming. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. These books are available at Amazon. There's a link in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com.